I think people who think that traders pull money out of the market every month like it's some sort of a cash machine need to realize that that's not the case. Certainly not in my case, and a lot of people I know that's not the case. I'm not the broker's favorite client because I'm not the guy spinning up the commissions like crazy.
Like Mr. Bruce over here spinning up his commissions.
Stephen Goldstein, who said it to me on my podcast, he said that it's just we all have these emotions, but the successful traders just seem to be able to have a better control over their emotions.
What's up, traders? Welcome to the Day Trading Show. My name is Austin Silver. I'm your host. Today, we're sitting down with James Bruce and our special guest, Garth Mackenzie. Garth is from South Africa, now trading in the UK. Garth has over 25 years of trading experience. He's literally been trading longer than James has been alive. So you guys are going to love this one. It's a wide covering podcast. We talk about psychology. We talk about how technology has changed trading. We talk about just trading different markets, South Africa, the UK markets, the US markets. There's a lot here. You guys are going to love it. Make sure you connect with Garth. I put his links down in the description, and also make sure you're subscribed so you don't miss future episodes. There should be a new episode every 5 days or so. So make sure you're subscribed on iTunes podcasts, wherever you follow your podcasts. Make sure you're staying up to date with us. We really appreciate it. Now enjoy the episode. What's up, traders? Welcome back to the show. Today, we sit down with my co-host, James Bruce, and our special guest, Garth Mackenzie. Garth is from South Africa, currently in the UK, and we're really looking forward to chatting with him. Garth has his own podcast. He speaks with a lot of successful traders. He shares a lot of great content on social. So we're really looking forward to diving in with you today and really I want to know about your story a little bit, Garth, but I also want to know about why you decided to start a podcast, what you've learned from some of your guests. I'm really excited to chop it up. So it's good to have you here.
Yeah, thanks very much, Austin. It's great to be on your podcast, and James, also great to be on the other side of the mic from you, because I know I interviewed you on my podcast some time back. So it's good to be on the other end of the microphone for this one.
Yeah, absolutely. It's always good to have the tables turned. I was a guest on a podcast last night. I know, James, you said you were a guest on a podcast today. So it's nice to flip the tables a little bit and get to speak a little bit more than just asking the typical questions that we do, right?
Correct. It is. It's nice to be on the other side of the microphone and also not have to prepare, because I've not prepared anything. We're just going to talk. Let anybody. We're going to wing it. Yep.
People ask me all the time. The guy I did Dan Emerson. He was the episode before you did him last night. He's like, bro, can you give me an idea of what we're talking about? He was a little nervous, and I was like, bro, we're just talking about you. We're talking about trading. Like, don't overthink this. I think my audience really likes this show because it's casual, because I want them to be drinking a beer at the end of the day and just popping this in, driving home from the office from the trading day, and I pop this in and just get some insight. You know what I mean? And I try, like you do, you interview a lot of really good people that are just well-rounded from the background standpoint. I try to do the same. I don't want all Forex traders. I don't want all prop traders. I don't want all swing. I want all different things to try to show my audience the different ways of making money. But let's hear about you a little bit, Garth, before we get this thing rolling. Tell us, how long have you been trading? Why did you get into trading? And then maybe if you could stem that into why the podcast, and when did that start?
Okay, cool. Well, I mean, it's a fairly long story, but let's go right back. So I've been trading. I actually started trading when I was a teenager. When I was about 16 was when I opened my first actual live trading account.
I love that.
Yeah. So, and that, I mean, I'm 43 now, so I don't know, do the maths with that, 27 years.
We'll call it enough experience. We won't put an exact number to it. We'll just call it enough.
Well, it's experience, but you know what? I think in this game, like, there's never enough. You never know everything. You're always learning. And actually, there's some days where I feel like I'm just 16 again, learning.
You're damn
starting out.
Damn right.
So it's, this game can be very humbling at times. Yeah. So that was kind of when I started. I've been trading a long time. What got me interested was a strange story, but I went to a boys' school in South Africa that James would probably know, a school called Parktown Boys, and it was quite a rugby and cricket school. And I remember it was in quite an affluent area in Johannesburg. And one Saturday morning, my dad was driving me through to play cricket at one of our opposition teams in an area called Houghton, which is quite an affluent suburb. And anyway, you're driving through and there's all these mansions on either side of the road. And I said to my dad, wow, what do these people do to live in this kind of neighborhood? And he said, they're probably all stockbrokers. It was just a throwaway line. And I said, well, what does a stockbroker do? Maybe that's what I should do when I'm big. And he explained it. You know, he knew a little bit about shares. Anyway, he obviously picked up the interest, and he said, tell you what, I will bring home the newspaper from work every evening, because this is now, we're going back to like 1994. There was no online trading. You know, so if you wanted to know the share price, you had to either phone your broker or you had to wait for tomorrow morning's newspaper. So he would bring the newspaper home every evening, and we would mock trade. We got a fictitious amount of money that we started trading with, and we hand drew charts on the dining room table every evening.
Oh man, what a time to be alive, right?
Yeah,
Compared
it
to
was
what it
really
is
cool.
now.
Yeah, yeah,
And like when you
totally.
look back on it, it's so different. And like
It's so
all of us have
different.
seen Wolf of Wall Street, and all of my listeners probably know. Like it's funny you mentioned this because the guy that I just mentioned, Dan and Richard, both of them have been trading for a long time. Dan had been trading similar to you, like from when he was 16, and his dad
Yeah,
was heavily involved in it and kind of guiding him.
yeah,
So it's interesting to
yeah.
hear like it's been in you and been something that you and your family have been looking at for a long time before all this technology made it super easy. Like you said, back
Yes.
when it was like pen and paper on a newspaper, and you were looking at the
Yeah.
close price at the end of the day and seeing what we got,
Yeah, totally. Yeah, so that's kind of how it started, and we did well with our fictitious portfolio. And then, as I say, by the time I was 16, I decided I wanted to try and do this with real money, and I learned a couple of hard lessons. First of all, when you're 16, you don't have a lot of money, right? So, well, I didn't. So I put everything that I had into a stockbroking account, but it was not much money, and transaction costs just gobbled me up. So that was the one thing. And then I kind of thought, well, first of all, I made a lot of mistakes. You know, I thought you buy cheap shares, because if you don't have a lot of money, you can't afford to buy, you know, expensive shares or high priced shares. Let's put it that way, like Amazon or something like that, you know. So, you know, you go for the penny stocks. The trouble is penny stocks are often penny stocks for a reason.
Correct.
And often they're on their way to zero. So
Exactly.
I learned that the hard way. And then I discovered warrants, which your listeners probably know what warrants are, but if they don't, it's like
No, I have no idea.
so warrant is like a retail packaged option that
Interesting.
that you can convert into stock. So, and they're exchange traded products in South Africa, but there's an issuer, and there are market makers. In any case, it's for all intents and purposes, and to keep it simple, it's an option. And of course, with that comes extra gearing and extra upside, but also massive extra downside if you get it wrong. So basically, I learned that it was just a quicker way to lose money. So, and this is
I
all
love how
like
you say it like so cold. You know, I'm thinking about it. I think when I was studying for my Series 7, I think I had to learn what warrants were. Like I remember that
yeah,
being one of the vocab terms I studied.
yeah. So as I say, it's just it's like a retail packaged option,
Okay.
effectively. Anyhow, so I blew my account quite a few times when
How
I
old are
was
you at
young.
this point?
Oh, I was like 17, 18, 19, 20,
Trading
that
these
sort of
options,
age.
basically.
Yeah. I mean, I was a very slow learner. If I had to go back in my life and do it all again, I think I would go on some courses and actually try and get some proper mentorship to learn how to do it properly. Because honestly, I was just winging it. I had no idea what I was doing.
And your dad
And
didn't
I
have
just,
any experience either to kind of guide you. He was just opening the door for you, really, right?
correct. Yeah, exactly. He didn't have any specific trading experience.
Sure.
So so it was kind of like a difficult start. And I remember at a stage when I was about 22, I think I'd been trading for 6 years. And I worked out at that point that I'd lost enough money over the 6 years that I could have bought a brand new Golf GTI out the box if I'd have rather just
Jeez.
saved my money and put it in a bank account, you know.
Wow.
And that's quite a bitter pill to swallow, right? When you're
A
22
little
years
bit.
old.
But hopefully you
But
had the
anyway,
thought process too to think, yes, this is a bitter pill to swallow and I could have bought a car, but this is also maybe tuition. Did you have that
yeah.
mindset at all?
Totally. Oh yeah, totally.
Yeah.
I mean, I always thought it's all this learning, right? I always knew that it was possible to be successful as a trader because other people were doing it successfully. I just hadn't figured out the recipe or the way to do it yet. So I continued to pursue it, and I went to university, got a degree in economics, and then eventually my first sort of proper introduction to the market, I guess, in a professional capacity was that my first job was with a futures broking firm. And we were broking single stock futures and index futures to clients in South Africa. And that was a nice opportunity because I got into a dealing room. I got to exposure to traders, got to see a bit more about how the market works. And that was actually the first time in my life that I actually got exposure to people who kind of knew how the market worked and what to do. So there was a steep learning curve, which was really cool. And then I was at that firm for about 2.5 years. And then I got headhunted to go to another futures broking firm and eventually ended up running the futures desk there for that.
Are you
firm,
still in South Africa at this point?
Yeah. I've been in South Africa most of my life. I've only moved to the UK 3 years ago.
Got it.
So
okay.
but the vast majority of my career has been in South Africa. And ended up running the futures desk for this broker in South Africa, which ended up getting bought out by one of the big banks, and stayed around for a while. But I didn't really like the corporate side of it. Once the bank took over, became very corporate, lots of bureaucracy and red tape. And I always kind of joke that the bank that I worked for is called Nedbank in South Africa, and they've got the tagline. What is it? Sorry, you might have to edit this part out because suddenly I've gone blank.
No, it's okay.
Make things happen. That's it. Sorry. Make things happen. Right. Their tagline was make things happen. And I actually, I thought it was so hard to make anything happen there. I had to leave to make things happen.
So at this point, would you say you're still not like a consistently profitable trader, or would you say you're starting to turn the corner at that point?
I'm turning a corner at this point. This is where it gets interesting, though, because I had done well there as a broker, and we got nice bonuses and reasonable salary.
And
as
a broker,
month.
You're just selling it, right? You're not trading for other people, correct?
Well, yeah, exactly. We're not trading for other people, but we were allowed to trade our own personal accounts.
Of course.
But there were trading rules, compliance rules, and all that, which I found quite limiting. And it was one of the reasons why I wanted to get out and actually do it for myself, out of the corporate world. So anyway, you kind of go from this point of having a nice salary and a nice fat bonus every quarter, and now you suddenly, you're trading from home by yourself. You start from zero every month. There's no salary. There's no bonus coming in. That's quite a mind bender, and I don't think I was ready for it, actually. Fortunately, I did it at a time in life where I didn't have a family yet. I had no kids, no wife. I had very low, limited cost of living, and I had managed to build up a decent stake of capital to keep me going. So it was fine. But, from a psychological perspective, that was something I wasn't prepared for. The idea of going from that safety net of having a salary and a bonus coming in regularly to suddenly there is no safety net. It's now you against the market, or you against yourself, I suppose. But from a psychological perspective, that is a big leap. And I think it's a leap that a lot of people underestimate. Certainly I underestimated it. And it took me a while to actually kind of come to terms with it. I mean, what I've come to terms with it? Well, I ended up actually starting a couple of other things on the side as well. So getting a few other passive revenue streams.
Getting money right.
Not passive, because
but you're still working at it. But get the money right, so you're not just trading for your income.
Correct. Yeah. So I ended up, passive's not the right word. It's actually risk-free income stream. So I set up effectively a blog, but a paid subscription service where I sell my ideas and my research to clients who want to see it. Yeah. So that's a risk-free income stream. I still do that today on my website. I did a TV show in South Africa, which was great. That was like good exposure, and it brought exposure to my websites and to the other things that I was doing. Then I strapped on a trading course later on, and then got involved in a few other things. One of the banks in South Africa wanted me to freelance and do a bit of analysis for them, and I still, funnily enough, do that today as well. So all of these risk-free income sources I still do, because it does take the pressure off in terms of knowing where your bread and butter is coming from and where the bills are getting paid from. So I kind of like it that way, that I don't rely on my trading profits to live off, because I find it's lumpy. Some months you have great months, some months you make very little money, some months you lose money. That's the reality. It's not, it's not a straight line. And I think people who think that traders pull money out of the market every month like it's some sort of a cash machine need to realize that that's not the case. Certainly not in my case. And a lot of people I know, that's not the case. So you've got to actually understand that your income is going to be lumpy. There's going to be good times and bad times, and you need to kind of make it through the bad times.
I love that. The lumpy.
Yeah.
That's a term for the P&L that I don't think anybody on the podcast has ever used before. Now, really
But
quick, before I let you keep going, I just spin this to James for a second, because I'm curious, like your path really to me feels natural. You went like to work at a bank, you went to go institutional, you stayed entrepreneurial, you started your own thing, you started to bring other money in. And I feel like James probably looks at you and is like, yo, this is like a lot of what is similar to me. But for you, James, my question is, why did you not try to go work at a firm? Like, you have a dad who's an accountant. You have it like a professional father. Your girlfriend's father is a professional. You see these professional guys. Why did you just go straight retail, James? Why didn't you try to go work at one of these big banks?
That's a good question. So the reason for that is because I saw my dad working till 12 at night, having to fix everybody's mistakes that they would make at the office. So that's my reasoning. I saw my dad.
Is that really
not saying that I didn't want to work hard. It's just lifestyle. Like I actually walked I was playing golf yesterday afternoon before our call, and after the training session, and my girlfriend's buddies were like, dude, are you 65? Are you retired? What work do you do? And they're obviously teasing with me. They know what I do, but I'm like, that's why I didn't go into the corporate world personally. Yeah. But I do respect the guys like Garth and that do go into the corporate world, because it does open up connections. But I think I took a lot of shit, so I think I'm good with making connections without that.
Yeah, and you were saying, Garth, how now it's become like you pulled away from the bank as they kind of got more corporate. I definitely can relate to that. Our listeners, I'm sure, can relate to that. So what happened next then, as you started to kind of pull away from the bank? Is that when you made the pivot to just retail trading on your own and doing your own money and still running the blog and doing everything like that?
Yes, exactly. Yeah, that's it. So I left the banking environment, started trading my own capital, set up traderscorner.co.za, set up a course, started doing a bit of consulting here and there with the analysis that I do, and so on. And that's kind of how it's been. And that was 2009 that I made that leap. And by the way, I mean, you might ask, that's an interesting time to have made the leap, because that was just after the housing crash and the financial crisis. Yeah. And the markets got decimated. And actually, I took that as a good time to leave, because the business that I'd helped to build up in the bank had been, I mean, a lot of our clients got smashed, and it was going to be a big job to rebuild that business and build up that client base again. And I just felt like I didn't feel like doing that. And I thought, if I'm going to build something, I might as well, if I'm going to rebuild something, I might as well build something for myself. And I figured that was as good a time as any to leave. And also from an age perspective, I was 30 years old at that stage. And I felt that, I was young enough to take the risk, and that if I really screwed it up, I could probably still go back and get a job in the corporate again. So there was some sort of safety net, I suppose, if you want to put it that way. But I kind of felt it was a good time of life to do it. And if I didn't do it then, and if I'd left it too much later, I might never do it. And I'm glad I did,
100%.
And I do look back, and I sometimes I ask, okay, so what, should I have stayed in corporate? Would I have done well? I might have made more money, or I might not have. I don't really know. But the thing that I wouldn't have got is the flexibility of time. Yeah. And that, I think, is something you were alluding to a moment ago, James, is like, you can't really put a price on time, but having freedom of time is so valuable. So valuable. Like you say, James, you go and play golf when you feel like it, if the market's not great or you're not seeing much. I also enjoy being able to go out and watch my kids play sport, or go to gym in the middle of the day if things are quiet.
I think that's the best thing about it. I think unlimited income potential is great.
Yeah.
But like I've been working with people who live in other countries where they don't even need $10,000 a month and they can live a good life. So like the money is the tool to give you access to the time. The time is the freedom. The time is the currency,
Yeah.
So then why do you think it's like this now? I'm curious, Garth, like when you were brought up, I'm sure part of the reason you went the institutional way with the banks is because other people around you were doing that. And you were like, oh, this is the path. This is the path. But now there's kids that are 18 making $100,000 a month from their prop firm. There's a whole new path for this. So like lifestyle has come to the forefront of the career decisions. My father, he's 70 almost. And he said to me the other day, he's like, when I was a kid, like your age, when I was 20, 30, 40, there was no thought about like, do I like my job? You just did it. Like you picked a career and you just shut up and you just be good at it and do it because that's what you chose to do. Now, like I said, it's all like this. Our generation is much more lifestyle focused. Why do you think that is? What do you think spawned that?
Yeah, it's a good question. I mean, look, from a trading perspective, let's just understand one thing is that the technology has enabled this.
Yes.
So when I started out, why did I go into the broking world and join a firm instead of just starting to trade, for my own account straight away?
It probably made trading cheaper, right?
Well, yeah, sure. But also, in those days, the technology wasn't there to do it. You didn't have online trading.
Right.
You didn't have, you did have computers, but you didn't, as a retail client, you didn't really have access to online share trading or like we do today, or you didn't have, a phone app that you could trade on. So I think a lot of those barriers have been broken down by technology, which now does make it much, much more easily accessible to everybody. And in addition to which is the transaction costs have come down as well. So it's become, from that point of view, it's also become a far more accessible thing to do.
Yeah, we're becoming technology like cyborgs. You know what I mean? Like the kids nowadays, they know how to use the technology faster. Totally. I know you. And listen, if I'm feeling it, Garth, I know you're feeling it. We're like, sometimes I see these kids. I've mentioned them on the podcast. I've had a couple of them as guests, 100K months. It's like, I thought I was doing well. You know what I mean? And then you see these kids that just know the technology, they can use it much faster. So I think their learning curve is just different than what it was for a guy like you, or even for guys like me and James. So now let's fast forward a little bit to today, Garth, if you don't mind. Talk to us about like what you do today. Like, let's actually go like this. I'd love to hear your daily routine, because you moved to the UK. So now you're in a really good, not that South Africa is a bad time zone for trading, but you can trade both sessions. You can do a lot. So what's a typical day in the life look like for you now?
Yeah, so a typical day in my life is that I still do publish my work to my South African clients, where we have an 8:30 a.m. deadline to publish market research, and that's an 8:30 a.m. South Africa deadline, which means me being in the UK, we're an hour behind, but in the winter we're 2 hours behind. So I'm kind of on the wrong side of the time zone. It means that I have to wake up super early in the morning to start working, which I actually enjoy, believe it or not, except in the UK winter, getting up at 4 o'clock in the morning is a bit tedious. I'm not going to lie. But in the summertime, like it is now, I get up at 4:30 in the morning. It's already light outside in the UK, and it's great. The birds are chirping. It's not. I quite like getting up early and sort of feeling like I get the full use of the day. But I get up, I start doing some research, look at what's happened overnight, look at the Asian markets, look at the currencies, look at the commodity prices, see if there's any events, economic and company related events due to come out on the day, and kind of plot a plan for the day ahead. Look at charts. I mean, I do a lot of scanning of charts, both over the weekend, but also every morning as well. Basically scan my watch list to try and see what stocks are setting up. I've got a bunch of technical setups that I like to trade, and I effectively scan the market looking for those setups. And when I see them, I kind of flag them. And if I see there's an opportunity, then I'll kind of make a note of it, put some alerts into the trading system if you're looking for a particular breakout level to break, or you're looking for a support level to be tested, because if it's just me trading, I've only got one pair of eyes, right? So I find using alerts on the charts and on the trading platform very helpful, because what it means is that levels that I've maybe identified when I'm doing my research, I've got all these other pairs of eyes effectively watching the levels for me. And every time a level gets hit, I get an alert to be told, like the other day, gold is broken, it's reversed up at 1950. And that's an area where I was wanting to buy it. So and I wouldn't have seen that because I was busy doing something else, but I got an alert that popped up, and I looked at the trading action at that point and said, right, this looks good. This is doing what it should do. It's reversing up. I need to be long here. And I've still got that position on right now. Nice. So, that's kind of how the morning looks. My mornings are very busy because I'm doing all of this research, then also publishing it for my clients say my clients are in South Africa. They're actually all over the world, but there's a majority of them are in South Africa because that's where my history is and where I've got a reputation. Then the trading day starts, and it's a case of, if there's a trade to do it. If there's not, you're watching, you're keeping an eye on the news. etc. I don't like to spend my whole day in front of the screen. And I know some traders do that, and there's certain styles of trading that require you to do that. For me personally, I don't like to be in front of a screen the whole day. I actually do like to get out and about. I try and get to gym every day or every second day. And typically I go like late morning. So about 10, 11 a.m. I get to the gym, which is more or less lunchtime in South Africa. And yeah, the style of trading that I do, as I say, is it lends itself more to holding for a couple of days to a couple of weeks, maybe even a couple of months in some cases. But that's the style of trading that I do. And I'm not super active. You know, I'm not the broker's favorite client, because I'm not the guy spinning up the commissions like crazy.
Like Mr. Bruce over here spinning up his commissions. No, I'm just kidding. So what do you think on like that? That's all very, very well said. I didn't mean to cut you off there, but what do you think on like average month? How many trades? 5, 10?
No, it's probably between 10 and 20.
Okay. So you're, I mean, I would say for a swing trader, that's pretty active. Would you classify what you do as swing trading more than day trading?
Yeah, I would. Yeah. Swing trading. Definitely.
Do you find, okay, so sorry, you go next, James. Wait, do you think as time has gone on, Garth, have you shifted towards swing trading over day trading with age?
Yes, I have. I definitely
Everybody says that. Everyone that is like all the guys that listen to every podcast of mine know you were going to say yes before that, because I ask a lot of the guys that, and everybody has the same answer.
Yeah, I just think less is more. I don't think that trading more actively and doing more necessarily yields better results. I kind of liken it to, you know, if you think about the way a leopard hunts, and I know you guys in America always love to say that, think about the way a lion hunts, but I'm going to correct all of you now. Right? Lions have a very low probability of success when it comes to hunting, actually.
Yes.
And they hunt in packs.
Because the lions are and the lions, they stay back and they watch the pack, right?
Yeah. But a leopard is what you want to be, right? Yeah. Leopard hunts alone, and a leopard is very, very patient, waiting for the right opportunity to come along, and it stalks its prey and waits. It can wait hours, and it waits for that right moment before it pounces and it attacks the impala or whatever it is that it's chosen for dinner that night. And but the point is that those animals, leopards, have a much higher kill rate than lions do. And as I say, they hunt alone, but they're also much more patient. And I think that's the way I would aspire to trade, is to say, right, I know what I'm looking for in the market in terms of setups. Mm-hmm. So now I just got to wait for those to come along and spot them. And when I see them, then act on them. And I know I'm going to mix my metaphors here, but, you know, again, also being a good South African boy, I liken it in a way to scratching for diamonds, right? We've got a big diamond industry down in South Africa. And I think about it like this, you know, every time I'm scanning my charts, I'm looking, I'm digging, I'm scratching, and I'm scratching for diamonds. I'm scratching to find the setups that meet my criteria. And in that scratching, sometimes you find a small diamond, and that's a trade that, you know, small trade, maybe it makes a 1R return. But every now and again, you come across a big diamond, and that's the 5R or the 10R that you want to dig out. But the fact is, if you ain't doing the scratching, you're not going to find anything. So that's the way I kind of look at it. And I find the more I do scratch around and look, the more opportunities I see. But then it's, of course, also having the skill to not just necessarily act on everything you see. You've got to be quite selective in terms of the opportunities that you do pursue.
When you coach traders, how are you teaching them about selectivity development?
Well, I identify certain high probability technical patterns. They're typically breakout patterns, but not always breakout. Sometimes it can be a pullback into support. And then you say, well, what are you looking for when you pull back into a support level? Well, you're looking for a reversal. You're looking for evidence of volume coming in. You're looking for stability. You know, maybe you're looking for the hourly candle to take out the prior hourly high, that kind of thing, those types of things. So what I think is if you just identify 3 or 4 high probability technical setups that you know have on average a better than 50-60% success rate, trade those, and don't trade anything else. Just wait. Just be patient for those setups. And the thing is, if you're looking across enough markets, and I'm looking in South Africa, I'm looking in the UK, I'm also looking in the States. I mean, there's loads out there. So to find 10 or 20 good trades in a month is really not actually that difficult. And then it's a case of managing your risk and managing your psychology. That's actually the most difficult part. And that's where I think you get differentiated as a trader. If the really successful traders that I've come across in my time, they just think differently. They have a different psychology. They understand risk, but they also know when to press, so that, to try and maximize their winners when they are right, but they're very quick to cut losers when they're wrong. And that's a psychology that I think doesn't always come naturally to people, but it comes with experience.
Yeah, that. Garth, you've been trading for longer than I've been alive, so I love speaking to guys like you. I mean, sorry to if it made you feel old, but I'm 24, and you've been trading for 27 years. So in your responses here for the podcast, you have quite a unique idea, let's call it, or tactic. You said, what is one of your biggest struggles in trading, and how do you work through it? You said impulsiveness, which I think we all do sometimes, but you said, I still struggle with it sometimes. I've placed my execution PC on the other side of my office at a different desk. So I need to physically get up and walk over to make a trade. It creates a bit of a tripwire to prevent impulsive actions. How did that come about? And
I love
how
that.
did you think of it?
I love that. Listeners should take note of that.
Look, I don't know. It's just something I kind of came up with one day. I had a spare PC, which is that one behind me that you can see there, right? And I'm sitting at my desk where I'm talking to you now, where I do my emails and I do my analysis and research and charts and everything else. But I've made that my execution PC, right? So it's just there. It's only like 3 meters away. But the fact is, that PC goes to sleep quite quickly. So I have to get up off my chair, walk over there, wake the machine up, then I've got to type in my password to wake the machine up again, get into my trading system, and then execute the trade. And I think that just slows me down in the sense that I'm not, I don't have the screen open in front of me constantly where I can just hit the button, buy, sell, I do. I mean, even after all the years of experience, I do struggle with impulsivity. There's no question. You do
You're
sometimes think, oh, you're still a human. We're still humans. We're not robots. And I think, there's this notion out there that the best traders behave like a robot. I don't know if that's true. I think it's just that they've kind of gotten a control over their emotions. But we all are still emotional creatures. We're human beings. And it was Stephen Goldstein who said it to me on my podcast. He said that, it's just, we all have these emotions, but the successful traders just seem to be able to have a better control over their emotions. You can't get away from it. And what he said is basically your emotions are like your shadow. You just can't get away from it. It's with you. It's with you all the time, but you can learn to control it a bit better. Yeah. And I found that just, like literally putting a bit of a tripwire in place between myself and the execution machine, it does, it means that if I'm going to go over there to put a trade on, I've really got to mean it.
It's serious business. Yeah, for sure. What markets are you trading, Garth? Because that was one thing we haven't touched on yet, because I know they probably changed over time. So what are you doing now?
Yeah, so I do still trade a bit of the South African market, because that is where I have grown up. The stock market, the equity market, in terms of asset classes, Johannesburg Stock Exchange trading equities. But that market is becoming very, very thin, and unfortunately, low volumes. There's been a lot of shares that have delisted or been bought out or whatever.
Is that because money is going into the US markets? Why is that happening?
For a variety of reasons. So there's been a big foreign exodus out of the South African market, because it's just such a small percentage of the emerging market index now. But also, yeah, South Africa's got its fair share of troubles politically, economically.
What are you talking about? You guys
etc.
pay homeless people to direct traffic there. What do you mean you got problems?
They're doing it because the traffic lights don't work.
Right, because you guys turned the power off. Right. It's crazy.
Yeah. So, unfortunately, with all of this, there's been quite a big exodus of foreign money out of South Africa. And not only foreign money, local money as well has also left to go.
So what does that mean? They're going to take the rand and they're going to go turn it into dollars and store it in a foreign bank?
Sure. Turn it into dollars and buy other stocks, buy US stocks or European stocks.
That's Richard still has his US brokerage account, even though he's in South Africa. He still
well,
trades
we
both
all
markets.
do. We all do. I mean, I did when I lived in South Africa, and anybody with a bit of money and a bit of sense would do that. Yeah. Because I think it's prudent. It's diversifying your wealth.
So what do you guys, I mean, since you're in the UK now, what's all the fear porn here in the United States is about South Africa joining Russia and China and getting away from the US dollar. But when I talk to people on the ground in South Africa, nobody's telling me that they're using Russian rubles to buy things right now. They're still wanting US dollars. What are your thoughts on all that?
Yeah. I'm completely with you on that. I mean, I think the US dollar is the world's reserve currency, and that's not about to change. Yeah. Maybe in a decade or 2 decades time, maybe there's another currency that comes up and it sort of starts to vie for number one spot, but I don't see that anytime soon. The US dollar is the world's reserve currency, and there's nothing close to it at the moment. I agree. So I think all of that sort of fear mongering is probably a bit misplaced.
It's for the headlines. That's what it is. Just like the last couple of weeks, it's been the debt ceiling. And then what happens? They raise the debt ceiling. They've done it 90 times since World War II ended. What did you think was going to happen? They run it through the headlines. It gets everybody scared. It creates reaction in the market. And then they do the same thing they've always done. Kick the can down the road.
Yeah, totally. But you were asking about the market. So I was saying, I trade South Africa still, but that's become a smaller part of what I do. I've more and more shifted. Well, the vast majority of my capital is in offshore markets in dollars. So I'm trading US equities, indices. I like trading the S&P 500 and the NASDAQ. I also trade options, predominantly options on the index. So be that options on the NASDAQ or options on the S&P 500. I quite enjoy doing structures which run out for a month or two using options. So they can be put spreads or call spreads, those types of structures using options. And that's where I find as a nice way to express a medium-term view is to do it with option structures. So there's that. I do dabble in a little bit of currency here and there. Pound dollar, I quite enjoy trading because I find that moves around quite nicely and it follows the technicals quite nicely. Euro dollar obviously also does. And then others like gold, like oil, so predominantly if it's got a price and it moves, I'll have a go, I'll trade it, but it's got to fit my technical criteria.
Love that. Yeah. I love that. Go ahead, James.
You mentioned here as well, Garth. I think this is quite a big one for. I think a lot of traders, especially me, had realized this early in their careers, it would have saved them a lot of pain and heartache and emotions, as we were speaking about. But you said here your aha moment in your trading was position sizing methods taught by Dr. David Paul. I've heard of David Paul. Can you maybe elaborate on those methods, those position sizing methods?
Yeah, look, I mean, I think for probably a lot of the listeners to this podcast that might seem obvious, but it's the bog standard. Let's just use an example. You've got $100,000 in your account. You want to risk 1% of your capital. Okay, so that's $1,000 you're willing to lose. Right. Now we've got a situation where we're going to buy a stock that's $50, right? And we're going to put a stop loss at $49. So you've got your risk per share is $1 per share, and you're willing to lose $1,000. So to calculate your position size, you take the capital you're willing to lose, which is $1,000, and you divide that by the risk per share, which is $1. So it means you can effectively buy 1,000 shares of the stock that you're wanting to trade, right?
Yeah. Mm-hmm.
And this is simple stuff, but before I'd never thought about it like that. never thought about risk in that sense, in terms of how much am I actually willing to lose. You always think, well, how much am I willing to make, or how big, what sort of size position am I willing to take here? But actually, the right question to ask yourself is, how much do I want to, well, no, how much am I willing to lose to find out whether I'm right on this trade? And that's it. And it was an aha moment for me, because it also meant that my P&L swings started to become a lot less volatile when I started to apply that methodology.
Why? Because you were sizing correctly, or just because you were cutting your losses smaller and letting your winners run?
Well, both. I think I was sizing the positions correctly, but I was also making sure my losses were contained to a limited percentage of my account.
Sure.
Whereas before, I hadn't ever really thought about that. You'd run a position, it'd be down 5, 6, 7%. And that creates very volatile P&L swings, and I didn't like that. And I think it does. It also is maybe an age thing as well, and I just don't have the appetite for that kind of volatility anymore. I suppose it's also because, as you get older, you get more responsibilities. James, you've still got to get to this point in your life, but kids, bills, school fees, home loans, mortgages, car payments, all of these things.
New cricket bats and equipment for the son.
Yeah, exactly. Or like my son, who lost his cricket helmet last week, and now we've got to go and buy him a new cricket helmet because Dad will just buy another one. so these kind of things. I guess as you progress through life, your financial commitments become bigger, and as a consequence, your appetite for financial loss also diminishes. Well, that's been my experience. Maybe it's not everybody's. But
I think it is. That's very well said.
I think that there's that saying about pilots. There's old pilots and bold pilots, but there's no old bold pilots. I think that I think the same applies to trading, right? There's old traders and there's bold traders, but there's very few old bold traders.
Damn, James, you already got one thing not going for you, bro. You already got that bold check mark, bro.
I'm not saying bold as in that. I'm saying bold as in,
I know. Yeah. I know. I was just joking. No, that's great. I mean, it's very well said on your part, but I think it is just a good reminder for all of us. Really, it is. So now, as you've been continuing to constantly just see markets change through technology, through different presidents, through different economic situations, because like James said, you've been trading for a lot of years. Just talk to us maybe a little bit about, what do you see coming? Like, do you think there's some strong trends in the dollar that we should be on the lookout for? Today, dollar index is what, 103, 103.40, something like that.
Coming down a bit, yeah.
Yeah. And so any thoughts on like future? I just like to get everybody's gauge on future.
Yeah. So look, I mean, I'll talk about it in the space that I'm mainly familiar with, which is the equity space.
Yes.
I'm finding this market, there's a lot of conundrums we faced with at the moment. It's a market where there's not a huge amount of participation in the rally currently. And there's been lots of coverage about this on Twitter and what have you out there.
Right.
But if you look at the S&P 500 equal weight, it's the chart doesn't look good. It actually looks
it's 7 stocks holding this thing up. That's it.
Correct. Exactly. Yeah. And so when market breadth is that narrow, you do kind of think like, okay, so S&P's up today, it's above 4,200, but it's very narrow leadership that's taking it up there. And how can we trust that breakout, or is it going to be a fake breakout? It's going to suck everybody in, and it's like a classic bear market rally, sucks everybody in, bull trap, and then spits them out on the other side.
Come on, you have the experience. You think that's what this is?
Well, I do think that's what it is. But the fact is, I mean, I could be wrong, right? The markets that markets can stay irrational longer than you can remain solvent.
Yep.
So that's what we've always got to remember. And yeah, I mean, I'll tell you what I think, but what the market actually doesn't care what I think. The market's going to do whatever the market's going to do.
Of course.
But so where are we now? So we're S&P 500, we're above 4,200 right now as we speak. Does it stay there? I don't know. If it does stay there, I think that the pain trade is possibly higher because I think there's a lot of people like you and I who think that it's probably, this is an unhealthy market. There's narrow leadership. We're staring down a recession. The effect of interest rate hikes hasn't yet been fully felt. There's a lag effect of that.
They're even still saying they're going to continue to raise rates today. They said they might even continue to do it. So wouldn't that be bearish? But then here we are, just ripping to the upside,
Well, the thing is, exactly, we're ripping to the upside. So you can make a case where all of this stuff should be bearish. But what I think, and again, this is what I think, and the market don't care what I think, but it's what I think, is that it probably will go up. It'll probably squeeze out all the bears. And once they're all squeezed out, then it will do the obvious thing, which is go down.
So what do we go, 4,300, 4,350, something like that?
Yeah, maybe. I mean, so 4,300 and thereabout is a 61.8% retracement of the entire bear market through 2022. So that would be like an interesting technical area where one would expect a little bit of resistance to potentially crop up. And I think if we sort of explode up into that area, which is feeling like it might do, then and we almost get a little bit of an exhaustion up into that zone. That would potentially give me more confidence that perhaps a short-term top gets put in somewhere around there.
How do squeezes end? Squeezes end with a violent push at the upside at the end, right? They get that last little squeeze out, that last little bit of pain, make sure everybody closes their shorts, and then it goes.
And that's right. And the thing is also, if you look at the positioning, there is a very big short position out there.
Huge. One of the biggest in the last like 10 or 15 years. You're talking about like institutionally, right?
Correct. Yeah. So, the one thing about shorts, is they have to buy back at some point. And they would obviously like to buy back when it's lower. But if the market keeps ripping higher, they're going to end up being forced. They're going to be forced to cover, and that's what's going to drive the market up. And that's probably the thing that'll be the one that creates that sort of blow off top when the last bear has been killed. That's when the obvious thing will probably happen.
And then hopefully we're still alive and we can back up the truck and start loading up the shorts and start waiting for the thing to come back down.
Well, that's it, right? Just, you want us to be one of the ones that actually does manage to stay alive for that. But of course, in the interim, there's opportunities,
long and short,
if
100%
long and short. And if we're talking this way and we're saying the market feels like it's going to squeeze to 4,300, then why aren't we long? Right. That's 100%. The hard trade. That's the hard trade to do now.
It's easy but often the hard trade to sell it on the way down, but it's not easy to sell it here as we're up 13, 15% from the bottom. 20% from the bottom, whatever it is. It's a tougher trade. Exactly. So I'm glad to hear someone like you with experience also feels the uncertainty that I have 7 years of experience. So like I see this is very uncertain. This is not clear like 2020 or even 2021 into 2022 where you knew what was going on. You know what I mean? The raising interest rates sent the market lower. The cheap money in 2020 sent the market higher, right? So Fed drives policy. And now with Fed members, half of them saying, we might raise rates. We might pause rates. We might, who knows? We might. Like it's just this constant, like one day you'll see the percentage likelihood of the rate hike be at 70% next month. And then within the next day, two speakers said something last night. Now we're at 40% likelihood. So very much, it's very tumultuous.
It's very headline driven, and exactly that, which makes it tricky. And that story about interest rates, I think one thing we've got to keep in mind is, yes, hiking interest rates, has the effect of slowing the economy and what have you. But I suppose right now we've got to look at it and say, if they are still talking about further rate hikes, which is not what the market's expecting, well, then what does that tell you about the economy? Maybe the economy is stronger than they think. And that's what the equity market is kind of telling you at the moment as well.
Fair.
So, you got to think about
what? Wait, I have to my point on that. Like the economy itself could be strong, but that depends on what do you consider the economy? Because when they look at these reads, for example, unemployment used to not categorize or count people that had more than one job. You were either full-time employed or you were part-time and unemployed. They've changed the way that we read these numbers. And I think that it puts a veil over what's actually going on sometimes. So I don't know, even if the numbers look strong, what's every day? What's the everyday person? Are they struggling or are they doing well? I think everyday person, a lot of people that I know have multiple jobs. They have a job and then they're doing something on the weekend, running a photo booth at a party, driving for Uber Eats, doing something else to make more money. I don't know if that's signs of a strong economy. In my opinion.
Yeah, I mean, it's a very good point. A very good point that you make. And I guess if we go back to thinking about it, look what we said about the S&P 500 equal weight. That's where you're stripping out the Apples, the Nvidias, Microsoft.
And we're up 1% this year.
Exactly. And there are a lot of stocks in the US that are looking weak.
So,
maybe that is what that is a more accurate reflection of the economy. The overall equity market, the S&P 500, the NASDAQ, it's not an accurate reflection of what's really happening.
Because why is Nvidia ripping? Well, what else would you dump your money into if you were a big fund right now? Give me another stock. They already own Apple. They already own Amazon. Like, think about it from their perspective. The money in those other stocks is already deployed. They're looking for this. We all know, and I'm curious if you agree with this. I think the new bubble, like we lived through the tech bubble, we lived through these. I think the new one is going to be AI. The tech companies that lead us through with AI. So if I'm thinking that, and I'm average Austin, just sitting here at home doing my Twitter research, the hedge funds are thinking that, and they're looking for the next big AI play. Okay, NVIDIA speaks about it. All the money goes to NVIDIA. And then, like you said, look at the equal weight. All these other companies, one of them is out there that's going to be great with AI. They're not even attractive right now because all the money is just going to NVIDIA, and that's why it jumped 30%.
Yeah. That and look, I mean, not just Nvidia, but that space, anything that's that is, so like AMD is another one that's done pretty well, and there are others. So there are AI stocks out there. I mean, anyone listening to it, I suppose, go and look at the BOTZ ETF. That's the robotics ETF. That's got a lot of AI stuff in it.
Oh, it's up beautifully, bro. From the bottom in October, it's up
exactly
63%, 61%.
Yeah, so that's your your diversified AI kind of play, if you want, and if you could probably fish around in there to see what the constituents of that ETF are, if you want to try and identify some other AI stocks which maybe still have legs. But I agree with you that it is the next bubble. It's certainly shaping up to be that way. And the thing about bubbles is that you just don't know how big they inflate before they pop, and often they will inflate more than you think that is possible.
Right. And you don't want to be Peter Schiff saying end of the world, end of the world, end of the world, and you miss a great bull market. You got to get in.
Well, that's it. I mean, and the thing also about a bubble, remember, is that like it starts off slowly and then it picks up speed, and then it's sort of the charts become steeper and steeper and steeper. So the last, I don't know, the last quartile of time in that bubble is probably when the vast majority of the money gets made. But the trouble is, historically, that's also when, the shoe shine guy and the hairdresser.
I was just going to say,
barber,
bro, when the taxi driver's in there.
Yeah,
right.
Those are the guys like coming in and getting involved at the top. And invariably, that's the time when the smart money is actually taking profits. And the taxi driver or the barber or the shoe shine guy is the bag holder. So I suppose the lesson is there's money to be made in bubbles, but manage your risk and don't chase it if it's already looking too steep. I guess you got to just be a little careful.
Yeah, I love that.
And don't short it. That's the other thing. Like don't short
it
because that's the other thing, right? Is guys will look at it and say, oh, Nvidia is up 300%, whatever. Yeah,
right.
It's a short.
Bro, it's going to be up 500% tomorrow.
Yeah, exactly,
so relax.
Exactly. Yeah. And the other thing is you don't have to try and pick the top, right? You really don't have to pick the top. Just go back and look at any stock that's gone parabolic as in a bubble, and look at when it eventually peaks and it has a massive pullback, then it'll have a rally and it'll fail and make a lower high. That's the time to get involved on the short side if you want to try and short these things. Don't try and short them on the way up.
While it's moving up, right? That's exactly. Just like you don't want to try to buy and try to catch a falling knife. Just stay out of the way. Yeah.
Exactly. There's plenty of time to short these things once the bubbles burst. You don't have to do it. You don't have to try and be a hero trying to pick a top when it's still going up.
I saw there was a play on, I think it was Solana. I had a sell signal on it on a weekly or monthly chart in January of this year. It's down 60% in 5 months. Well, when did the bear market start for these altcoins? Like 18 months ago. So you do not have to be first, and you can still see double, triple digit returns. 100% agree. But you will lose double, triple, quadruple digits on the way up if you just keep trying to sell before you have any idea that it's going to fall over. I remember I was talking to Scott Redler once, and he was saying he was able to quote, like after the Bitcoin rally in 2017, he knew exactly the price that the 8 and the 21 EMAs crossed down after the run up. He's like, that should have been your first and last sign to say we're out of all longs at this point. Now we can start to look. Just simple EMA crossovers are what a lot of these guys look at, and it's very helpful. So Garth, this is such good insight. Such good insight. I have one more question for you, if you don't mind. Did you have anything you wanted to chop in on this, James? I don't mean to.
No. I've enjoyed listening. This is not my expertise, but I enjoy listening to.
I know you're always quiet when we go into the stock stuff. And in my head, I'm thinking, I'm like, yo, James needs to get his shit together when it comes to this. So he knows. James is like, what's NVIDIA? What do they do?
No. Don't. I'm not
No. So wait, here's my last question for you. So as someone with, I would say, more experience than majority of our guests, if you have to look back at yourself when you first started trading, what is one piece of advice that you would go back 20 something years ago and tell, let's even say the Garth who is working, not just trading at home when you're 16, say like 25, 26-year-old Garth, the corner is turning, you're working at the banks, seeing that, what would be the best piece of advice to give you then?
Sure. I mean, if I could go back and to the beginning, or to when I was 20 years old, I would go on, a bunch of courses and actually learn how to trade, get the foundations right. I think that's important. It's not everything, but because psychology is the vast majority of what makes you successful or not as a trader. But I mean, I think I started with very weak foundations just in terms of everything. And I would have, and see this as a learning experience. You're always a student of the market. It's a constant learning. You're never going to know everything. You're constantly learning, and see it as that. It's an adventure.
I love that.
But also, manage your risk and know that I don't think trading is a get rich quick scheme. It's a get rich slow scheme. And I think too many, and I include myself with this, I thought it was going to be a get rich quick scheme. And when you're young and you've got, big balls and what have you, you want to go and swing for the fences. I lost a lot of money swinging for the fences when I was a youngster. And if I had have actually had the foresight to say, this is just do it carefully, just do it slowly, build your wealth slowly, you actually, you'll do better in the long run like that.
I love it. Great advice, Garth. Yeah. Thank you for the time, Garth. This has been an amazing episode. I'm sure the listeners love it. So for everyone that is still here, make sure you check out Garth's social media links down below. I'm going to put those in the description. Make sure you subscribe to him on Twitter and get updated everything there so you can stay up to date on some of his ideas. We love that. And if you have any questions for Garth, put those in the comments on YouTube. Let us know what you guys think. If there's anything you want us to ask Garth next time we sit down, we'll make sure to check those comments and get that to him. So for now, we're going to put a pin in this, Garth. I really appreciate you. James, I really appreciate you. It's always good to chat with some South African traders. I know you're in the UK now, but still a South African good old boy forever, right, Garth?
Yeah. Oh, yeah, always. I'm still supporting the Springboks forever.
forever. So we love it. We appreciate all you guys listening. Make sure you follow and connect with Garth down below. Make sure you're subscribed here on the podcast so you don't miss our next episode. And we'll see you guys in the next one. Thanks, everybody.
Thank you.